Hello, everyone, and thank you for joining today's webinar on financing India's sustainable energy transition, instruments, markets, and principles, organized by the International Institute for Sustainable Development and Indian Institute of Management, Calcutta. I extend a warm welcome to all of you for joining from various corners of the globe. I am Deepak Sharma, Policy Analyst with ISD's Energy Program based in New Delhi. ISD is an independent think tank having offices across the world. ISD has been operating in India for more than a decade. ISD works on issues of energy and sustainable development. We've been tracking government support to various energy technologies and support the national and state government in their effort to shift support from fossil fuels to clean energy in a just and socially responsible way. Now, coming to the topic of the webinar on financing India's sustainable energy transition, instruments, markets, and principles. This topic is both timely and relevant, considering the critical role of finance in India's energy transition. I'm going to announce a few housekeeping rules before we kick off today's webinar. This webinar is being recorded and will be available on ISD's official YouTube channel. The link to the channel will be provided in the chat box. We welcome you to revisit the content yourself and share it with your colleagues. We also invite your comments and questions. You can see the comment and the Q&A box on your screen. Please post your questions in the Q&A box at any point during the webinar. And if you have a question for a specific panelist, please post that as well. I'm now going to hand over the webinar to the moderator of the event, Dr. Dhruba Purkayas, Climate Policy Initiatives Director, India, and Director of US-India Clean Energy Finance, to start the proceedings. Thank you.
Thank you. Good morning, and thank you, Deepak. Thank you for the introduction and starting this off. Thank you, IISD, IIM Calcutta, CTEP, for inviting me to moderate this important session. Just to start it off, we have the panelists as follows. We have, and probably that is the given sequence in which I'll kind of address my questions to. Neha Khanna, Senior Manager with Climate Policy Initiative at India Office. I'm going through the screen. Shantanu Srivastav, IFA. Vaibhav Pratap Singh, XCW, currently an independent sustainable finance consultant. And Suranjali Tandon, professor at National Institute of Public Finance and Policy. Thank you all for joining in. Just to set the context before deep diving into the questions, I think it's greatly aided by the summary Professor Mrityunjay Mohanty did for all the papers written by Neha, Shantanu, Vaibhav, Suranjali, and a few others too who have not joined the panel today. But it's a very interesting sequence of dealing with the problem or the solution to financing energy transition. It's possibly the whole of climate change problem that we are dealing with. It probably is the single most massive chunk. If we get this part right in finance, I think it puts the world and the country towards a proper path towards what we call net zero or carbon neutrality, as the case may be. And in this sequence, as we start looking at the problem, and it's very much in sequence as it goes. And this will also be the sequence of the discussions that we will do, is how much of money is required, where will it come from? We clearly know that the world at a whole, the country, the gaps between what climate investment is required, what energy transition investment is required versus what's going in, there is this gap, and that is what we need to think around, what we need to address. And in order to address this problem, one, there is a definitional issue we come to, a conceptual issue of transition. Then we come to sources of finance of which can be managed, which is Vaibhav's paper on doing it. Then Shantanu deals with the capital markets, the institutional investors, and in the whole of it, then Suranjali's work contributes to getting into saying, what's this element of just transition? Is this transition, how is it going to affect communities, producers, consumers? What's the impact like? And where is this just transition money going to come from? And there is therefore the linkage between public finance coming in. So it's a very interesting, at the same time, circular and holistic mix of the papers that have come out. And with this introduction and with this setting the context, if I may start off with my questions, and it will go as follows, just to set some rules or the order. I'll have an initial question for the participant and another as we go by, and the sequence is Neha, Vaibhav, Shantanu, and then Suranjali. And then as time permits, we'll get into a follow-on question for each of them. Hopefully, we'll be able to complete these 2 rounds in the given, well, I can see I have 50 minutes, but let me just 5 to 7 minutes, what the first question, if you all can limit it to 5 to 7 minutes on the order of magnitude from a response, that will allow everybody to speak and also have a second round of questions, and therefore allowing Professor Mrityunjay Mohanty to kind of summarize the takeaways as he gives his closing remark. Thank you. Any questions, if at all? I can start off with, if it's okay with all, I can start off with my first question directed at Neha Khanna. Given the paper that you have contributed to in this book, the whole concept, and you've done a sort of a very interesting, I would say, interesting delineation of financing transition and what is transition finance per se. And therefore, if you could explain that to this audience that we have today, including the panelists and the audience which has joined online, as to the conception of what is financing transition, what can get defined as transition finance, and therefore how does this essentially help in bridging this gap? This is the starting question, because this is about transition. It's important that we talk about understanding the process of transition holistically, and therefore at the same time look at defining a sub-element of transition finance. Over to you, Neha.
Thank you, Dhruva. Thank you to IST and AMCAL for providing me this opportunity. To address that question, at the first level, when we talk about financing transition and transition finance, the first assumption comes to mind is they must be similar. But in reality, transition finance is a subsector of financing transition. And that's a very key concept to understand. Because when we talk about financing transition, technologies that come to mind are renewable energy, clean transport, energy efficiency. And those are the sectors which get a lot of prominence and a lot of funding. However, most countries, and especially India, need to transition. And in that phase, they will have to go through, or they will have sectors which are either hard to abate or will have emissions associated with them no matter what. They may be reduced, but they will always have emissions associated. And even to transition completely to, let's say, green, will go through a phase where there is a reduction in emissions. And that portion, which does not get covered under the traditional definition of green, largely comprises of transition finance areas. A very simple example in this case would be the steel or the cement industry. While the cement industry is already at a stage where they're very efficient with their processes, the steel industry needs to decarbonize. But will they ever reach a place where they have zero emissions? Not in the near future, and maybe highly unlikely ever. So how do you finance these? Because these become hard to finance sectors, because when we look at different sources of capital, whether it be public finance or philanthropy or commercial capital, there is increasing focus and aim to financing green. And in that process, this sector at times gets either overlooked or becomes exorbitantly expensive to actually finance. So that's the first level of setting the base. What can be done? to actually enable this sector to receive more finance. The way we looked at the problem is that we say that there are three challenges that you have. You have a definition or a classification problem. The second is you have a higher cost of capital. And the third is the lack of adequate financial instruments. Now, what do I mean by all of them and the potential solutions to all of these? Transition finance does not have a globally accepted definition. There have been seminal pieces of work done by CBI, done by the ministry in Japan. The new ASEAN Sustainable Finance Taxonomy 2.0 also takes a crack at it. But there is no globally accepted definition of transition finance, which makes it very difficult from a financing perspective to identify whether a technology, whether a sector, whether an industry will fall under the definition of transition activities. So to find a solution to that problem, have transition pathways and define transition activities. Have benchmark for emission reduction targets. And these are necessary for better implementation of protocols or frameworks such as SBTI even. And the most talked about in all fundamental aspects is the MRV, or the reporting and monitoring aspect of it. Because till the time you can't capture, understand, you cannot solve it. The second problem that we have is the cost of capital or the higher cost of capital. Look at different mechanisms, de-risking, blended finance. And the third is the absence or, well, limited availability of transition finance instruments. You have a transition finance bond and you have a sustainability linked bond, but the way they are currently defined are limited in their application. Also, they are limited in the stage of capital that they can be used at. So the problem requires solutions at all levels, from policymakers in defining, from regulators in putting in prescriptions, and also in putting in rules for new instruments, and from the markets in actually having pathways to be able to address them in their institutions, to have products being rolled out which can address specific problems. So Dhruva, with this, I'll hand it back to you. Thank you.
Thanks, Neha. Thank you, Neha. I think it's a good segue and a good explanation of creating a separate genre or an instrument or a labeled instrument, which then does not discriminate the good against the great of being green, and also the explanation to saying transition is the financing of the overall process of increasing renewable energy, EVs, decarbonizing industries, and so on. This leads me to Vaibhav. Vaibhav, you have talked about in your paper quite a lot in terms of saying that, yes, there is a huge and a massive requirement even in India of renewable energy, even at the level of what we are planning on renewable energy, that's sort of kind of unfinanceable, if I may use the word, or finance will fall short. And this is the view that you have held. And please correct me if I go wrong here. And you've always held this view, comes out in the paper. And therefore, you have then gone on to delineate, saying that these are the few things that can be done in terms of structures, in terms of instruments, in terms of funds, and in terms of how this can be bridged. And both includes initial financing and refinancing. With this background, can you just summarize a few key takeaways as to where you want to come from in terms of how can India diversify its financing options for renewable energy projects to reduce banking systems exposure, support alternative platforms, and then thereby have a shot at bridging this gap? Over to you, Vaibhav.
Thanks, Dhruva. Thanks for the question. And thank you, I am Calcutta, and IISU for inviting me to this webinar. So before I talk about the financing requirements or the channels that could be used for this massive infrastructure buildup, I would like to say, because given whatever I have experienced in my life, working in the finance, infrastructure is all about debt. It uh, it could be basically McKinsey saying that you would be the banking channels could have a 100 billion interest opportunity by 2030 if projects around the sustainability are built up. So, of all the $6.5 trillion of interest that these bankers usually earn, they can add $100 billion more to it. And infrastructure, as we know, as Neha pointed out, uh, will come through pathways, through targets, and others. Will require a lot of debt finance to come up. As per some of the calculations that I did for net zero, India by 2030 would be requiring somewhere around $500 billion of investments in the power sector. And of this, around $380 billion would be roughly in the form of generation capacity improved, of which $200 billion need to move into this decade between 2020 and 2030 in the renewable energy space. And the rest, 120, $140 billion in distribution. Uh, I would say the transmission part of it. So when we talk about the, and you also alluded to the fact that the banking sector may not have the space. So when we look at the books of Indian banks, so it's roughly $90 billion that's invested out there in the power sector. Another $100 billion in the form of the two largest NBFCs that India has, PFC, RAC, they contribute. So roughly $200 billion is invested. And these majority of these loans would be 10, 15 years. And if we go by the same pace that we are adding up 10, 15 gigawatts of renewable energy every year, this would be fine because you will have a debt space of around $10 billion of additions or $11 billion, $15 billion, whatever is the number, those could be. But India's targets is somewhere around adding 40 gigawatts of renewables. And that becomes a problem because your banking space will have to serve. India is a very highly regulated financial market, especially the banks and the NBFCs part of it. And if they have to meet their other demands and other uh, serve the other sectors as well. So where will the money come from? So that's a problem. So the easier route is either India goes for very large banks like the way China did. Because if there is a problem of $500 billion, you can't build up a SBI that is almost a 50th largest bank and the largest in India, fill up the void and come up financing for that. The easier route for in the shorter term would be having some IDFs that the India has already adopted, is looking forward to since now again back since 2012. They're a part of the ecosystem for a long time, but by 2012 they again India started looking because they could take the initial construction part of the risk, which banks today are taking up, and those could be the fundamental institutions that could support the banks in building up the projects out there. Or I would say a large institutional setup would be required, though it's not mentioned in the paper, like a bank that could allow something like those construction risks to be taken up because few of the new alternatives like InvITs, which could be used for refinancing or refinancing either the books of the developers, which are either hitting their exposure limits to the bank or want to do newer and projects, or something like AIFs, which could allow NBFCs or banks operating in the space to just get rid of their to make these portfolios off the book and take up more exposure on the newer projects. And that has to come, as Neha pointed out, from the targets actually materializing. You will have to have a pipeline of 50 gigawatts, or 40 gigawatts, or whatever is the number of projects to come up every year. And then these refinancing options will become mainstream and could allow a lot of new projects to come up, I guess. Uh, this is how, or since transition is not flat and there are lots of technologies, and a lot of new technologies are coming. So a de-risking instruments would be required for most of the traditional channels to open up as well. And the other point that I missed completely over here is the bond market. India's bond market, though is not one of the largest, it's 11th largest in the world, I guess. It's around $2 trillion or something. It's has to grow and has to have uh, renewables in it, at least for the starting, where the ticket size could be suited for something like having something like, and also the ratings have moved to something like A or double A now, which is the norm, where most of the double A and upwards, where most of the bond market is placed today. So some guarantees, some showcasing instruments to make sure that the bond flow at least starts, or most of the buyers of the bonds start getting acclimatized to these type of securities would be quite useful, because government has taken the first step. Now they have created benchmarks with this year's or the last year this year's sovereign green bond issuance, which gives the industry an idea of as to where they are placed. So I guess the long-term answer would be having larger banks, getting more institutional money from abroad as well. Because if we look at the balance sheet of most of the corporates in India, their exposure from the foreign side is on the lower side. While when I talk about $100 trillion of banking balance sheets, $35 trillion is invested across the boundaries of the nations where they are placed. So though we can talk about MDB reforms and others, I guess the main bulk of money need to come from the larger banks, and in the short term, some de-risking instruments, opening up the bond market and refinancing would be quite critical, because nobody really wants to have an exposure of 16 years, 18 years on a single loan. It could be given smaller chunks into smaller pieces, where bring in the investors of different nature across time horizon. I guess that is how I would like to summarize the chapter.
Thank you, Vaibhav. Thank you. You've put in many transactional points. But yeah, I quite understand and like the concept of saying the banks really cannot do this in the present state, in their existing exposure, their limits, but India is primarily banked. Can we have IDFs? Can we have alternative sources? Can we have look at refinancing with some benchmarks and surrogates? Can we do some de-risking around this bond markets, and also bond markets needs to grow for sure. So thanks a lot. This at this stage leads me, given the time that I can see, leads me to Shantanu. Yes, you have dealt a lot on the domestic institutional investor in terms of saying the regulatory environment and the financial sector environment, where India is just unable to direct domestic institutional investor, whether it is pension, insurance. You've covered a lot in insurance too, to where this long-term requirement is in clean energy, in longer term clean energy, decarbonization, any projectized investments long-term as far as energy transition is concerned. And Yen, so would you elaborate a bit more on saying or summarize the constraints here? Because what I want to place to you is what have actually contributed to the limited participation of domestic institutional investors in renewable energy, and maybe more, what is the regulatory reform required in overcoming these challenges? So here is over to you on domestic institutional investors. And there's a large pool in India for sure. Thank you. Over to Shantanu.
Thank you, Ruba. I hope I'm audible.
Yeah, you are.
Okay, thanks a lot for that question, and thank you, ISD CDEP, for inviting me for this webinar. It's great to share the dice with Ruba and all the other eminent speakers.
Can you speak a little louder?
Yeah, is that fine?
It's better. Yeah.
Okay. So So the reason I actually wanted to focus on the domestic institutional investor when you talk about financing requirements of clean energy sector in India or energy transition in India is because there's been a lot of talk in terms of we need capital from foreign institutional investors, ESG capital pool that is available in the developed markets, but we also have a very large pool of assets, institutional asset that is present in India itself, which is, we have not really been able to mobilize into the clean energy sector in a very material manner. So that is where I wanted to understand what is the current scenario and what interventions are required to make sure that we are able to tap into this huge pool of capital. So let me just start by giving a context in terms of what is the size of the institutional capital institutional investors or DIIs in India. And I'm just going to focus on the life insurers and pensions over here because I think they're probably the most well-suited DIIs to provide capital for the infrastructure, long-term infrastructure needs such as RE. So uh, in combination, the pension funds and life insurance sector in India manage assets of close to $900 billion, somewhere around $920 billion. Right, they are probably the biggest debt and equity investors in India. Additionally, on an yearly basis, EPFO plus NPS, which are the two large providers of pension services in the country, they do somewhere around 43 to 45 billion of new investments. Right, that is each year. At the same time, the life insurance industry earns around more than $100 billion in fresh premiums. A large part of that goes to new investments. Uh, Compare that with the size of corporate bond issuances in India just last year. India did a landmark $100 billion worth of corporate bond issuances in FY 2022-2023. So just these two pool of capital providers are doing more investments in one particular year than the entire bond market, corporate bond market in the country. So we can imagine, and obviously the $900+ billion of capital that they're managing is humongous. Now, a large part of the capital that flows into these entities every year has to be necessarily invested, and this investment pattern is decided by the sectoral regulators, IIDI for the insurance sector, PFRDA for the pension sector. Now, my first problem or the issue or intervention is that the investment regulations by these two sector regulators have been highly restrictive in terms of the investment options that are provided to the insurers and life insurers and pensions in India. So for instance, somewhere around 40 to 50% of incremental investment assets by entities in these two sectors have to necessarily be invested in state and central level debt. For IIDIs, it says 75% of incremental debt investments in each year have to be necessarily made in government securities. EPFO says you can do that, do somewhere around 35 to 40% new investments in corporate debt also, but most of that has gone into PSUs. Now it's good to know that there is such a huge capital pool available to plug the budget deficits of the states and the center. More so in a scenario where the central government has such ambitious infrastructure development plans, right? Not just in renewable, across the board. Uh, and But if you see, the kind of, if you just look at the renewable energy sector, what kind of capacity additions have happened in the past, a lot of that has come from the private corporates. And going forward, also a large part of our capacity additions in the RE sector is going to happen from the private corporates. Now, when you have these two states, the states, the governments, and the center, which on a yearly basis almost squeeze in all liquidity that hits the bond market, it leaves very little capital for the corporate issuers to then tap and finance their long-term infrastructure capital needs. And that is why, like Weber was mentioning, they have to rely on the bank financing, right, which is not obviously the most appropriate institution to finance long-dated infrastructure assets. So I think that's one issue, saying that the investment options from IIDI, PFRDA have not been too conducive for investments in the RE sector. Secondly, there have been options. For example, I mentioned 35 to 40% investments in corporate debt by PFRDA. There is a supply side problem, which is to say that there aren't enough AA and above rated bonds, debt instruments available in the market from the corporate end for the for the insurers and in the pensions to invest in today, right? So even where you have regulations, there isn't much investment options available out there for these entities to invest in. There also is the issue of maturity. So if you see today, a lot of the insurers, life insurers specifically, are moving towards longer maturity investments, right? Government securities, the 10-year GSEC is the most liquid security today. There is a lot of demand to 10-year to 40-year, government papers today in the market. So there is a necessity for longer term, securities. If you see the kind of green bond issuances, onshore green bond issuances that have happened.
Sorry, Shantanu, can you just hold that a little closer to the mic, a little closer? Yeah.
Is
Thanks.
that fine?
Yeah, that's good. That's good.
Okay. So if you see the kind of green bond issuances, onshore green bond issuances that have happened in India, I can think of two of them. Both of them were AAA rated, but they were only for 3 to 5 years duration. So they just go below the duration requirement of these long-term investors. That's on the debt side. On the equity side, if you talk about LIC, right, which is close to 80% of the total AUM of the life insurance industry, so IRDA allows investment in both listed and unlisted equity, right? But if you see the unlisted equity part, just 0.5% of its portfolio for LIC is in the unlisted equity side, and it said it's never had any problems in selling off its unlisted portfolio. So there's not been any issues of liquidity. Now, from an RE perspective, we have a large number of developers who are not listed on the browsers, right? Because of LIC's investment preferences, a lot of these large RE players, I don't want to name any of them, but there are a number of them, right, in the market today. They are not able to get that domestic institution capital, right, which would be really beneficial. And then they have to go outwards and depend on, institutional capital from other countries. And there's been a lot of institutional capital that has come into RE companies in the past. So that's another problem. Another issue that I see is that both IRDAI, PFRDA do not allow investing in debt or equity on a project level. Right now, you see there is a lot of de-risked operational cash generating infrastructure, RE assets in the country, which are underpinned by 25-year PPAs, which are backed by a lot of them are backed by PPA signed through SECI, which have payment security mechanisms in place. But because there are no regulatory options available, insurers and pensioners are not able to invest in them. Compare that to a situation whenever there is a new RE asset, operational RE asset on the block for sale in India, there is so much demand from foreign institution investors to invest into them, because they understand these are the right assets for us to, and these are the assets that really fit our risk return profile. So again, that is something that I see as a gap and really needs to be developed. Then there are other points in terms of there is no consideration of climate risk when you talk about any insurers, or at least the larger state-owned insurers and pensions in India. So in the risk, assessing the risk, portfolio risk, you do not consider those kind of metrics. So there is no nudge towards diversifying into low carbon assets or RE assets for that matter. There is no ESG consideration in the investment decision making process also, right? So there also there is no nudge towards diversifying into RE assets. So I think these are some of the major issues that are prevalent today. Most of them are on the regulatory side, and again, all of them need regulatory interventions. They need a concerted effort from the sector regulators to make sure that there is more DIA participation in financing India's energy transition. I'll stop there.
Oh. Thank you, Shantanu. Thank you. I think this is great, and you have literally laid out a regulatory prescription for the DII to be used and directed, if policy wants to do so, towards where the timelines between asset liability timeline frameworks can be matched. And very, very interesting observations on what regulation today constrains and what possibly needs to happen with PFRDA and IRDA. I think there is a prescription here, clearly delineated in terms of some of them would be accepted, some not, but surely there is a way forward here. Thank you so much. Let me now go to Suranjali. Yeah, we are coming around to what we now call justice and transition, and how just transition, as the acronym has now emerged out. How do you integrate just transition into mainstream development finance. I'm not too sure whether I would have time for the second round of questions coming across. Hopefully I have, but still, if you wish to, Suranjali, bring out where you have written how private and public finance particularly needs to shape up in terms of addressing, without getting into, I would say, necessarily into aspects of distributive justice, etc. Just about from a fiscal point of view, and how does this justice element get into transition from your paper which you have written and from anywhere. Over to you. Thank you.
Thank you, Dhruva. And, I'd really like to thank Mrityunjoy, Runa, and the entire team for letting Neha and I set our imagination free and to define what we thought was just transition. I think over the last 3 years, we've been talking about this, and we've, for the first time, put down together our thoughts on, just really defining what just transition means to us. I think one of the things that we wanted to talk about is to dispel this association of whole with the conversation on just transition, to say that this is an economy-wide effect. As per my thinking, I think no one is going to be spared or be given the luxury of time. Just because you see large corporates, you see public finances, and you also see communities and consumers being affected all at the same time. And what we do is to think about what are the instruments available where you can embed the principles, so-called broad principles of just transition, which is to say that no one's left behind. So to my mind, there are two pieces which Dhruva has asked me to talk about, which essentially speak to the core of addressing social sort of impacts, while also saying that you can do green with addressing social impact. So we've had this discussion under the SDGs. A lot of people intuitively draw the links between the different SDGs to say that they're not competing in some ways. They could be co-benefits approach, which we also saw this year. So with the sovereign green bond. So Shantanu also mentioned it. The previous speakers have mentioned this. The document mentions that you could have an approach where this could bolster or bring positive effects on the social side. And I think it's possible to do it through the development financial institutions because they've been in the business long enough. The important part, and I do think which can direct capital is a clearer definition, which we sort of talk about throughout the chapter on saying what really means as India's just transition. What is the landscape of India's just transition? Which can be articulated through a well-defined taxonomy. This is to say that these are our goals on social, these are on environment, and they're tied together. And I think most financial institutions bring up the fact that they don't have enough guidance on what the itself can translate or translate India's priorities, can also transition the way finance is moving.
Sorry, Suranjali, you can turn your video off because there may be a bandwidth problem so that voice comes out clearly.
Perfect, thank you. Thank you. So, I would say that there are a bunch of things, as I've already mentioned, that you could have disclosures and taxonomy framework which support the flow of finance, which define, in a sense, priority. We've seen experiences globally as well. So if you look at the EBRD, which is in Europe, which we cite as one of the examples, they have a just transition framework. They've already started lending to countries such as Poland, Greece, and North Macedonia. And so one way to do is to recapitalize these. India's no stranger to having these institutions. We have a bunch of them. We have SIDBI, we have NABARD. We also have the NAPFID now, which is talked about a lot. But we also have to look at their balance sheets. We have to look at their capitals and also have to look at their internal frameworks and say how this money can be directed to the flow of activities which are aligned with just transition. There's also been efforts in this regard. So I am aware of CPI, RMI, and CBI taking a work on designing guidelines. And I think more of this work needs to be done without duplication. And I would stress that. On the public finance bit, since I know that there will be shortage of time on talking about it, I think it's a dual challenge. One is that you're going to see an evaporation of some of the sources of revenue, because today fossil fuels are about a fourth. I think this is well known and documented. About 4 to 5th of India's revenues accumulate on account of fossil fuels, and that's going to taper off. As we hear, everything that we do on expenditures today is related to SDGs in some way or the other. And so therefore, if we have to do much more, as has been requested by the IMF and the UN, so that means you have to expand on the expenditure side, and which means that, we need to think about how we are going to give our subsidies, which are not going to vanish. So a lot of people talk about let's reform the subsidies, but they are going to transform themselves into those that we give to renewable and the transition. So A, how we sensibly design our subsidies. B, what kind of taxes will we levy? What will be our new tax base? And related to all this is, what are the institutions, and it relates back to the first point, what kind of institutions will we capitalize to be able to fund this transition? There's also the aspect of, I think, international distributive justice, which we may have just, sort of brushed past, but I think it's being talked about quite frequently now with change of industrial policy and trade dynamics. And so that is also going to have feedback effects on your industry, on your public finances. So I think just transition also requires an articulation of a very serious theory of what needs to be the change within the public finance architecture, because all the private finance folks will tell you we need guarantees, we need credit enhancement. And what are these words? So it basically means that the government is supposed to support. And so where is that support going to be available and how it's going to be structured? I think that's my thinking on how we embed just transition into public finance. I'll stop there, Ruba. Thank you.
Thanks a lot, Sir Anjali. I think this was great in terms of get real on development finance institutions in India. Use them for development, for sure. On the fiscal side, yes, there will be lack of revenues, there will be evaporation of sources. So we find out new sources, add new taxes, whatever the case may be. But yes, there is a role. End of the day, it is like what you indicate is, yes, at the end of the day, all these risks at some point of time will devolve onto the public fiscal, public exchequer for sure. Thank you so much. But I'm not sure, I'm asking Deepak at 11:45. I don't think we have enough time to deal with questions, and Professor Mohanty's summary too. So should we open it up for questions and take the questions and answer? Everybody has a round and a go, and people have been very comprehensive in their responses to the opening question. Deepak.
We still have 45 minutes, and I think
sure,
I would need, yeah, we do. So we could actually have a short round of
going by wrong timing. Sorry. So then that's great. So let's have the second round, and we still have 45 minutes from here. Oh, great. So I was mistaken in the time that I had at my share, but thank you so much. Okay, now let's shift over with this initial introduction. We are getting into some sort of a deep dive, and I'll go around in the same order that I had gone to. Hopefully I'll be able to cover, but this time, given whatever time we have, let's keep it between 3 to 5 minutes in terms of the responses. So starting again with Neha Khanna. Neha, some examples of de-risking, blended finance, and implications of carbon pricing into this whole transition story. If we can have your views on both de-risking, blended finance, and implications for carbon markets pricing. Thank you. What do you rather?
Thanks, Dhruva. De-risking, I think Suranjali really put it very well. The private sector is going to ask for credit enhancements, guarantees. Let's add insurance also, since they're all de-risking mechanisms. But the reality is that there is going to be de-risking required. But before we get to the instruments required for de-risking, let's actually, and even Shantanu alluded to that right now climate risk is not really factored in. And when we look at it from a transition perspective, we need to get really, really specific here in saying that we need to measure emissions, because transition at the end of the day is anchored by reduction in emissions. So while ESG is great and we have that, and you have credit risk rating analysis, internal, external, all of that, you do not have in India dedicated ways to actually measure emission reduction and benchmark it. So you'll have emission reduction or internal pathways. You will have ESG ratings, which say that emission is captured under E, but it is also masked by a whole lot of other relevant parameters. So we need to get risk assessment frameworks in place which aid financing to these sectors. And a carbon rating tool or framework is possibly one of the ways which can support, and we see that happening globally. Like I said, they're not prevalent in India, but they exist globally, where companies who are transitioning through their transition pathways can show that we will reduce and we are reducing transition, and hence the cost of capital should not be exorbitantly priced. Second, and coming to the absolute heart of transitioning, what is the incentive for companies to transition? What is the incentive for private sector to transition? Because it requires money. At the end of the day, it requires money. And transitioning, unless there is external stakeholder pressure, is not really something that companies are looking for. So you need to have a price put on carbon. Now, people will say, but carbon pricing has been around for a while. Yes, it has. India's carbon pricing is so small. And when I say that, it's less than $5, more or less. It is not sufficient to enable financing these industries. So not only do you need to have your internal carbon pricing in place, you need to have your external carbon pricing to support them. Can that actually, carbon pricing, can that be used to support public finance? Maybe. Suranjali would be the better person to answer that question. But the bottom line is, whether it's public finance or private finance, you need to price carbon. And you need to price carbon efficiently and at the levels which India needs to transition to it. So roughly about $50 to $80 is what you're looking for in carbon pricing. And globally also those prices are hard to get. Blended finance here can play a role because it sort of brings in the patient capital, which can absorb the risk. And when we say patient capital, given what both Vaibhav and Shantanu alluded to, that these are long-term projects, you really need capital to be patient. You don't need capital to be patient for 3 years, 4 years, 5 years. You need capital to be patient for 10 years, 15 years. And if you can get that, especially from a debt perspective, because rightly put, and Vaibhav rightly said that, it has to be more debt financing. You need players to come in, be open to not get a share. So not to use the technical jargon, but effectively, if the NPA happens, they don't get a share back. So not only do they need to have a low cost of capital, they need to not want a piece of the pie at the end of the day. They need to be ready to accept that, yes, this is the money that I've put for development, and park it aside. Lofty goals, maybe we'll get there, maybe we won't. But those are the things we need. So for blending, yes, it's a useful instrument. We need it. But till the time we don't get the blender right, till the time we don't get the right institutions, and yes, MDVs are not the only answer because their balance sheets are also limited. Till the time we don't get the blender right, even debt blended instruments are going to be a challenge, but they are the need of the hour. And there was a question in the chat saying that, do these financing mechanisms which are trying to push towards green, towards transition, would they take away from other development goals? And I think Suranjali really put it very well, and I'll just take 30 seconds to elaborate. Co-benefits is the name of the game, has to be the name of the game going forward, because none of these sectors or none of these activities are standalone. You can't do emission reduction. You can't say I'm going to finance XYZ and not look at how the ecosystem gets impacted by it. So education is equally important, but so is transitioning, because if you don't transition, you're not going to have livable conditions. So with that, I'll hand it back to Dhruva.
Thank you, Neha. Thank you. Thank you. I think very good points made, great ones in terms of saying credit ratings, carbon ratings, if you rate. So there is debt. Debt comes with carbon ratings, which means incentivizers in the price of debt. Externally provided carbon ratings, yes, a great point, so that each entity not left to its own path of saying, this is my transition. Let there be a third party and independent rating be provided so that you somehow shift movement of capital. Great. On the point of carbon, yeah, absolutely correct, because in the sense of saying it is a public good and private provisioning will always be under provisioning by the private sector unless you force through a regulation. Somebody somewhere has to pay for the transition, for the investments and the reduction that the private sector is expected to do. Otherwise, this does not work in markets. Thank you so much. Over to Vaibhav. I would like, Vaibhav, if you could delve a little deeper on the external borrowing sector, how international finance can be sort of creatively brought in, because what we see is, for sure, we are significant climate investments in India are domestically financed. But yes, international finance is there, does not come in, finances 15%, a lot of it. If you could dwell a little bit more deeper on your perspective on how international finance can be enabled.
Given the current scenarios, Dhruva, there is no way the international finance can come into this, because the Fed rates have just shot up. They were at around 50 basis points in the starting of 2022, and now they are at 5.5%. So your cost of borrowing has in the international market
it becomes benign. Let's assume that interest rate cycles go to the other side at some point of time. What's the structural approach here? You have written
the
some
structural approach. It's easy. So back in 2021, India had done a record issuances of the green bonds out there, both in Singapore as well as in the London Stock Exchange. They had raised somewhere around $7 billion of worth of money, and that was basically for refinancing a lot of loans out here in India and allowed a lot of fresh capital to come into the projects or the under construction projects, because India already has a pipeline of somewhere around, the number is 40 gigawatts of under construction projects, some say 60 gigawatts, whatever is the number. So these projects can have that money from the banks for taking up the initial construction risk. And so what practically happens is that many issuers usually hit the ceiling where their banking exposure limits they are hitting, and they are required or asked by the banks themselves or NBFCs that are financing them to get their loans refinanced so they can get a fresh issuances. And since the project already has a track record out there, it becomes easy for anybody to and since if we talk about, and there was also a question around FDI, almost all of the developers in India are, I would say, more of a foreign origin, where there are huge investments from both sovereign wealth funds as well as the pension funds are the owners of the largest of the developers in India. So equity is not a problem, but the debt, because once you have a project constructed out there, it's basically O&M are on the lower side usually. And your revenue would be in INR, so it's basically how you can just use the interest cycles to your favor and raise capital out there when, let's say, a few years down the line, there would be a lot of institutions that would be, there would again be a quantitative easing because there is a looming recession out there, and there could be things like these that most of the developers have become used to. So this would be the easy route, but the harder route would be the role of RBI over here and others to make sure that the foreign banks whose exposure is on the lower side in India, as to how they could be incorporated into something like, because if you need the capital of this scale, you may have to open up eventually. And that would be required because you can't meet all it on your own balance sheets, on your domestic balance sheet. So this would be a harder route, but something that you could allow. Because if we talk about the interest rates, last year they were somewhere around, the banks on an average earned $6 trillion. So somewhere around 6.5% was their cost of interest. If we had, let's say, the hedging cost 5%, so roughly 11% is the cost of hedge. So something that could be done about the cost of hedge or making, because solutions like sovereign rating going up are time taking and they would require their own, I would say, time, because though India has started with their own framework now, and one of my previous employer, K Ratings, has come up with a new benchmark of rating sovereigns, and they feel that most of the feeling in the Indian fora is that it could allow a 2 or 3 notch upgrade in the India rating, but that's a slightly far away thing because India would need a lot of capital to come up. So I think participation of within the bond space plus foreign bankers coming into the Indian space, whichever way the RBI wants to bring them in, given their previous hesitancy around the foreign bankers, many had folded up in the earlier roles as well, how they can come in and still be competitive. Because if India can provide the pipeline, I guess the bankers would be interested and they could be slightly safeguarded to an extent on the return side of it. Because if I talk about the P by B ratios of most of the banks abroad, they are in less than one range. And India is the biggest venture where you have 140 billion people. You can just use this opportunity where your electricity is shooting up. It's around 10% increase every year, and your renewable energy capacity is not going up. The problem of or the where you can use the mass market in India to grow and develop and increase your growth opportunities. And this would be required because if I talk about more macro situations, IRA in US is attracting has made sure that a lot of companies are moving to US, and Europe is also trying on its own of a $2 trillion something subsidy program that could allow investments to flow in. So India needs to either open up to an extent on the financing side to allow these banks to come up and make it, and they have made it through SECI and others attractive enough for these guys to invest in India by taking away the risk, the traditional risks that were associated. So maybe going away with the same approach and just inviting more foreign funding. ECB route, what I had seen through data was basically for refinancing a few wind projects is what had been seen in the last few years. So there is no magic pill that could allow the foreign investments to come into India, but I guess regulators as well as the Indian government will have to decide if they can allow more foreign players to participate in the form of debt, which is the need of the hour for infrastructure, I guess.
Yeah, thanks, Vaibhav. This was good again in the sense, yeah, capital markets would follow interest rate cycles and subsequent expected quantitative easing or Fed tightening. It does follow. At this juncture, we have a problem for sure, but that route will remain for green bonds, for whatever capital markets can raise, issuances from banks. But interesting point that you make is allow for foreign banks. Foreign banks have been leaving India. Allow for foreign space for foreign banks. So if you take the GFANS alliance, there is a net zero banking alliance. Allow foreign banks better space and access. That's a good point in the sense ECB is complex for Indian banks for sure. And so with this, these takeaways good ones in terms of to be made noted, and maybe at some point of time debated again subsequently before formalizing recommendations. Let me now move on in the interest of time to Shantanu in terms of saying, yes, there were the discussions on DII were very good, and therefore, what is it that the corporate sector can do in terms of business models so that domestic institutional investors come in? I do understand the regulatory restrictions, but is there something which the corporate India is missing out as to why LIC, EPFO, other insurance companies do not pick up insurances? Or are we missing something over here on the corporate side?
Thanks, Ruba. So I probably would not talk
Again, you have to get the mouthpiece a little closer.
So I wouldn't talk specifically on changes in business model, but some interventions that can be done again on the corporate side so that they're able to tap into this capital pool. And just going back to one of the points that I made earlier, that a lot of the domestic corporate bond issuances have not been in the AA, AAA rating, right? That particular threshold, which is investable by the insurers and pensions in India. And I mean, these are fiduciaries to capital for a lot of other beneficiaries in India. We cannot ask them to take risk by investing in something which is below investment grade or which is below AA for that matter. So what we really need at this point in time, and I think this is a short-term fix or a short-term measure rather, is we need an instrument which can enhance the credit rating of the bond issuances that are coming from corporate issuers in India. One thing that has worked in India that is available from an Indian perspective is credit enhancement guarantees. In the RE sector also in the past these have worked. ADB used to run a partial credit enhancement facility, I think till 2017. Renew Power and one of Mercury's asset, the bond issuance for one of their SPVs, used this particular facility and was able to enhance the rating on on their particular bond issuances. And this was in collaboration with IIFCL. The partner organization was IIFCL in India. So we've had instances where credit enhancement has worked, and RE sector companies have been able to enhance their credit ratings. RBI also has specific regulations which says that you can provide credit. Public sector, private sector banks in India can provide credit enhancement for corporate bonds in the country. So it's been a non-starter, right? Because the current regulations are not conducive enough for the corporates to actually make use of them. PFC from the power sector also runs a similar facility, but again, if you see the current portfolio, there are no guarantees, credit enhancement guarantees that they've rolled out. RBI recently, a very recent development that has happened is that RBI has come up with regulations for this establishment of a national credit enhancement corporation, if I'm not wrong, which is saying that there is going to be a central entity probably housed under IIFCL, which is going to provide credit enhancement guarantees to corporate bond issuers in the country. That's still not come, but if that does come, I think that's going to be an important development. But again, we've had these facilities in the past. What I think really needs to be done in the short run is to have a facility which really is workable in the current circumstances and from a RE sector perspective. Every infrastructure asset class has different risk return profiles, uh, right from roads to ports to even TND. So we need a credit enhancement facility which basically caters to the specific needs of the RE sector. So that's one. It could either be through the power sector NBFCs, PFC, REC, IREDA by tweaking the current RBI regulation. It could also be probably like a sovereign backed uh, credit enhancement guarantee, right, which is then again routed through these NBFCs. But we need that facility to make sure that we have issuances at least in that AA, AAA category, which is then investable by insurers and pensions. So I think that's one thing. The regulation is already there. We need some tweaking. Second thing that I think can be done, again, not from a corporate business model perspective, but an instrument that we already have in the form of infrastructure investment trusts, right, which is a very appropriate instrument for institutional investors such as pensions and insurers to, take an exposure to the infrastructure sector. The regulations in it, and these are similar to yield codes in the US, even though they weren't that successful. In India, we have very stringent regulations. 80% of InvIT proceeds have to be necessarily invested in operational assets. 90% of the cash flows have to be necessarily be distributed in the form of dividends, in the form of interest payments. So we have an asset which is very well suited for the needs of these DIIs. But if you see from RE sector perspective, there's only been one InvIT which was Versant back, which was promoted by KKR. It was also sold recently, or is going to be sold to IndiGrid, another power sector InvIT which is focusing on the T&D sector, specifically the transmission sector. So we've not really done enough. The RE sector players, I would say, have not really done enough in capitalizing on this instrument. Again, it's both a supply and a demand problem. We probably do not have a lot of assets today, operational assets today, which asset owners want to recycle into InvITs, and which are also AA, AAA rated, right? So that's also an issue. But I think this is an instrument that can really help recycle capital, tap into that capital pool of investors and insurers in India. Very good thing is that IRDA, PFRDA both allow investment into InvITs of listed InvITs by the regulated entity. So we don't need a change in regulation, right? Even though for PFRDA it's only for publicly sponsored or public sector sponsored InvITs, but I think probably if there is some traction in terms of newer InvITs coming in the sector, they are going to also be open to the private sector InvITs. So that's one, and these are, I think, the short term or fixable things that can be done. But overall, I think in the longer term, we need, bond markets which are deep, which are liquid, which again corporates can tap into and finance their infrastructure need. But that's work in progress since a very long time. SEBI, RBI, everyone has been trying to make interventions to develop those bond markets. But at least in the short term, we have these two things that are available and can be leveraged upon, tweaked a little bit to make them workable for the RE sector. So yeah, I think these are the two options that come to my mind in the short term.
Thank you, Shantanu. I guess what I understand very clearly is not about corporate business models essentially, which will need to be tweaked or changed. It's an issue of the instrument is rated, and therefore there is a need for a central credit enhancement, institutional credit enhancement. Banks can do, but they're not incentivized enough. For sure, that is true. And yes, you are right in saying that was announced, and we don't see that happening. So the need for a credit enhancement for making the institutional capital flow, yes, for sure, a major recommendation that can come out for sure, and that would surely help going ahead in terms of directing long-term institutional capital, the current structures of InvITs, yes, for that matter, being allowed, or InvITs for renewable energy, InvITs for. But the interesting point that you make is you relate all of this to long-term infrastructure, almost similar. That's very interesting because transition is infrastructure in the nature of infrastructure. Thank you. Last question. We have 2 minutes to go on to Suranjali, and therefore, before I hand it over to Deepak, within the time frames, I'm still there. I think. Suranjali, lastly, any thoughts on balancing fiscal considerations, carbon pricing, and subsidies? Because that is, to my mind, appears to be the key for getting a just transition done. And you have subsidies, you have fiscal loss, and the tool that you have is carbon pricing for the state.
Thanks, Dhruva. I think I'm going to focus on.
Yeah, you can switch your video off.
I think what I'm hearing, there are global headwinds, and then the capital will not flow into India. But what we've seen, despite Silicon Bank, despite what we've seen since 2020, the Indian stock market has been actually resilient. If the equity market is moving north, why is it that we still think that financing transition aligned sectors is risky? I think the answer there is that the price metrics are still not designed to nudge people to move to these new sectors. And I think that's why I think it's important to nudge people to behave in a way as we would see as aligned with this transition. And I think that's key. I've been writing about this for quite some time. There are two ways to this. one is, of course, we have the carbon markets, and the other is to also have a carbon tax. And I say that they should coexist because the public finance problem also needs addressing. There are a lot of sectors where we talk about just transition where private sector will not go. It's important to acknowledge that. So I think carbon pricing is an important missing piece of the puzzle, which speaks to both the public and the private finance, and can bring that shift. So I'll stop there and thank you, Dhruva.
Thank you. Thank you. Yeah, carbon pricing and getting the carbon markets to work is the key here for sure. Thank you so much. I think I'm right on the dot with 10 minutes and 10 minutes for Q&A and summary. So let me call on Deepak here. Thank you so much.
Thank you, Dhruva. I think there are a lot of questions already that whether we will be able to address them in 10 minutes.
You have the
would...
prerogative to choose. You can choose and place them to the respective panelists.
Yeah, I'll try my best, as well as I think these questions can also be addressed when the book is released, and you can find it addressed when you read the chapters. But I'll start with the first question, and I'd like the panelists to speak up if you think you can answer the question. So I'll come up with the first question on by Yash Narayan, which is, apart from multilateral financing and government support, how may India meaningfully unlock untapped capital pools such as pension funds, venture debt, sovereign wealth funds?
Maybe someone who is willing to take that may put up their hand and take a shot at it.
I think we've partly covered that when I was talking about DIIs, and Neha, they've covered, I think, the foreign institution investor part also. So what specifically is the question? Is it on the unlocking?
Shantanu, can you bring your mouthpiece up, please? Thank you.
Yeah. No, I think this question has partly been answered on both the fronts, domestic and institutional, on the international side. But I think, again, from the domestic side, I can just pick that one. We need, regulatory changes to come in to make sure that, the investments by DIIs is conducive in the RE sector and the overall clean energy sector. And again, from the issuer side, you need intervention in terms of making, these issuances, debt, equity, both more attractive and de-risked for, DIIs to tap into. Yeah.
Yeah, Vaibhav. Yeah, over to you.
Yeah. So if this could be, I guess, is being raised from the domestic side as well as from the international side. I really do not know, but from the domestic side, Shantanu also, because when we see the Indian landscape of financing, it's quite highly regulated. So when you see PFRDA playing a role of within the insurer segments, have they come up with guidelines for somebody to make investments into renewable energy projects? Though Shantanu referred to a few problems or instances where so these mandates are still not there. So mandates could be a big way for domestic institutional investors to come into the picture. I guess is the way, or let's say LIC is asked to make few investments into something like this. And if I talk about so it's majorly a role of regulations that could allow, or mandates that I feel beyond the practical challenges around the buying a bond or something on the renewable energy side. Something on the mandates would be required for domestic side of these players to come into the picture. And if I talk about the international side of it, I guess where participation on the equity side is quite high. So when we talk about renewable energy specifically, they own almost all of these sovereign wealth funds, and others are owning majority share within these. And it's the debt side of it which is a problem. And that would require some regulatory changes again, or mandates from the I guess, the governments to make sure that something like this can be beneficial for these guys. Because if somebody is interested in the taking the most junior most position, why are they not interested in tech? Is the question. So it's the regulations or their preference for debt or equity side of it that's hampering their investments into something like renewable energy, which is the largest of the all portfolios out there. So I guess once the government and the others decide, these type of investments on the debt side can also start coming into India, I guess.
Thanks, Vaibhav. Let's go to the next question, Deepak.
Yeah, I think there are three questions on just transition. So maybe Suranjali could take this up. I'll just
You can read them out.
read
Read
out.
them out, and she
Yeah,
can take them.
yeah. Yeah, I'll read them out. Just transition is a public finance business. How can government leverage its own books to attract investments for facilitating just transition? As well as there is a question on what role can multi-development banks play in financing just transition in India, and who would be covering the social costs of just transition?
Maybe you can also mention the questions from, and then Suranjali.
Questions for all?
No, whose questions are we addressing? Because
yeah, so this question is by Michael on multi-development banks, and the first question was by Kavita.
Yeah, over to Suranjali. Yeah, just transition issues of financing.
Thank you. So I do recognize that just transition falls largely within the framework of what the government is already doing. But your question was specifically on how do you attract investment from the private sector. So I think there have been examples of not specifically the private sector alone, but let's start at the other end of it, where you have social impact bonds, which are small right now. They have a very specific request on the rate of return, but they are absolutely targeted. The other, which we are witnessing and we've discussed as well in our chapter, is the engagement between private sector and investors. So there are some investors that have already understood that this is a risk to be addressed, and so therefore they nudge companies to behave better within the frameworks of disclosure that there would be companies to report doing within their value chains, what they're doing with their employees, and so therefore that about risk of the vision.
Sorry, there's some bandwidth problem. We are not able to hear clearly. If you repeat the last 30 seconds, please.
I think we might have lost Suranjali. Can I move to the next question?
And the last
just one last question. Yeah, and this question I think could be common to all. This is the question by Susmit Datta. Is there a consensus on the annual estimate of finance needed to achieve India's 2030 or net zero 2070 goals? While the panel has put forward thoughts around new sources and instruments of finance that can be mobilized to meet the above estimate, does the panel think reallocation of this amount of funding can potentially limit funding for India's other development priorities like education, healthcare, corporate growth, etc.?
It's for anyone to take it. Neha.
Okay,
You are mute. Okay.
Yeah, no. So is there a consensus on the number? I'll actually possibly pass that to Vaibhav, since he in his earlier stint had come out with a net zero 2070 estimate. But coming to the second point, is financing to this going to take away from other development priorities? I think in the last few years, we have seen a shift in the funder investor mentality, where instead of looking at a project from a single impact focus, funders or money is now trying to look at co-benefits. At no point can one say that other factors will be impacted or will not be impacted. It will be sector specific in my view. However, as we are increasing the innovation in this sector, as we are increasing the awareness about this sector, you are getting solutions and technologies which are addressing multiple problems. So I think that is a fundamental shift that has already started happening, maybe a bit late, but it has started happening. And I think that will continue, and that will ensure that your flow of finance to the relevant sectors does not change. Second, to be very upfront and honest, India is a developing economy. The focus of the government is not going to suddenly shift from saying we don't need education to let's move this money somewhere else. So public finance is still going to have a role to play. Private finance is still going to have a role to play. I think you have additional capital that's coming in, and you have projects and programs which are getting designed with co-benefits to multiple sectors and multiple development agendas. That's my perspective. I'll leave it to the other panelists to add their views, or maybe even Dhruva to actually add his view.
No, thanks, Neha. Over to Vaibhav, and the last one before we go over to Professor Mohanty. Yeah, just
so
the number.
Since we are very short on the time, so these are the first estimates that are based on a few scenarios that were built, and based on our best guesstimate, I would say, around the cost of the technologies. Since it's a 50-year thing, I guess it's difficult to say if eventually India just needs $10 trillion or more or less. So, but it gives you an idea of what would be the requirements in the next 10 years, or based on the targets, as well as based on the current best understanding. And estimates are bound to be wrong. So don't worry about this. If they are wrong, hold back other guys to the sword.
Irrespective of estimates, I think the gap remains large. Therefore, the focus of this is how do we direct when you're not meeting by 70% globally and not meeting by 70% in India, estimates of the order of 5 or 10% does not. So the pathway and the direction remains clear. Thank you all so much. And thank you for this brilliant discussion. And Professor Mohanty, over to you.
Thank you, Dhruva. And I have an extremely onerous task of trying to wrap up what has been a very fascinating discussion on instruments and markets and in principles that should be involved in tackling the problem of carbon transition, decarbonization. So I'm going to try and sort of summarize for what each person has on the panel has said, and then try and do a broad macro wrap up at the very end. So let me go directly to the first person who spoke, Neha Khanna from CPI. I think the most, in my view, fundamental and important point that Neha makes is the lack of taxonomies. And the importance of the fact that unless I know what something is, it becomes very, very difficult then to create a market for it. So I think she listed out 3 sets of things that require our attention: a taxonomy of pathways, benchmarks, and monitoring, a taxonomy for with the cost of finance, and how to create a transition finance for new instruments. Now we need answers to each of these, and as yet we do not have some of these answers, and we have some of these answers, and we need to flesh this out more carefully. And a taxonomy would allow us to switch money to green sectors. Vaibhav made a a couple of very important points, which had to do with the nature of India's bond markets and the fact that they are underdeveloped. The fact that they are underdeveloped partly is for supply reasons and on demand reasons. And so on both of these, we need to work. Vaibhav makes a very important point about the fact that India is a bank-centered financial system. And in a bank-centered financial system, the centrality, the centrality of bond markets, if we want to use markets in attracting different kinds of capital. The important point to remember is that equity is far better developed than bond, and ultimately the fact that the lack of corporate bond markets, which are not developed and deep and so on and so forth, is becoming a major constraint in the way we mobilize resources. Shantanu takes it forward by saying that, okay, the bond market is one set of issues. Who are your players? The players that we are looking at are, who are the big players in terms of who sit in big amounts of money, is really in India, insurance firms and pension funds. And globally, it's equally important to remember the fact pension funds are very big players, sovereign wealth funds are very big players, and we have to have ways in which we allow these to tap into these markets. And here, again, Shantanu points out the critical role of regulation. That in many, many ways, regulation is very, very conservative in India, justifiably so. India is a financial market which works within the fact that it's a developing economy, but the regulator has to take the bull by its horns and think of ways in which it is going to allow people to diversify their portfolios. And and come to Suranjali, then Suranjali's basic point was that yes, she's fine, but what we definitely need is a much clearer definition of what constitutes a just transition and how you bring that in, right? And in this, Suranjali points out, is the centrality of the role of development banks. She brought in the issue of EBRD, point to the role that NABARD can play, and so on and so forth. Now, so what we are getting in terms of players, markets, and principles, then, is the fact that keeping in mind the fact that India is a bank-based system, your big players, and some of whom are lacking in the market today, are your development banks, are your pension funds, is the LIC, and each of these looks at risks differently. But you need the development banks to be able to take on some of that risk, de-risk. You need pension funds, you need LICs to come in and activate, deepen those markets, allowing greater private sector investment in these. So it's a very quickly, what I would like to say as I wrap up is the fact that India needs a new financial architecture, which in a sense, it goes back to the future, which reimagines the role of development finance in the financial system and brings out a new architecture which allows both a subsidization of risk and a cross-pricing of risk. With these few words, I'll close for what has been a very fascinating discussion. I will remind all of you that this is the final webinar of a volume that's of the role of coal in a sustainable energy system, a wide-angle view. And this is the final webinar. The launch of the volume is for the 25th of September in Delhi. And all of you listening and all of you participating are most welcome to that launch, which will happen at the India International Center. With these few words, I hand it back to Deepak to say the vote of thanks. And thank you very much for asking me to wrap up.
Thank you, Mrityunjay. I think I would like to just say that we have received overwhelming response to this series of webinars, and the interest has stayed throughout. We are thankful to the panelists and the participants of the webinar. We do have a host of webinars coming up, and you can check ISD's event page as well. I'd like to thank the panelists, the participants yet again for an enriching discussion that we have had for the last 1.5 years, 1.5 hours. Thank you very much.